What if I told you that there is a 3 ETF portfolio that consistently beats the S&P 500, pays you steady dividends and also protects you when the market crash? You are about to discover a portfolio that combines the explosive growth, the stability and the balance. This isn't theory, it's backed by over 20 years of market data. And in the next few minutes, I will show you exactly how it works and why it might be the smartest way to invest in the US market today. Most Indian investors looking for US exposure settle on a single S&P 500 ETF like VOO or SPY, right? Because they are comfortable with the market cap weighing, which means giant companies like Apple, Microsoft and Amazon dominate their returns. You see a respectable 13.7% annual gains, but wonder if you are missing out on any higher growth or steady income. You are also stuck in a single strategy mindset, and you think that if I had picked the right stock or sector at the right time, you get a good baseline performance using the S&P 500, but you also miss out on the innovation, dividends and diversification that can boost long-term wealth. This is where the 3 ETF combination is great. Growth from innovation, captured by the Nasdaq 100, stability and income, delivered by a high quality dividend ETF, and equal weight diversification, offered by the S&P 500 equal weight ETF. Each of these ETF are for different market environment. For the bull market, QQQ or Nasdaq 100 leads when tech and innovation rally. Bear market, SCHD or high quality dividend ETF cushions downturns with dividends from stable companies. For the sideways market, S&P 500 equal weight ETF balances it by rebalancing some of its stocks. So the three ETF combination that I call as a Trinity Portfolio are QQQ, that is Invesco Nasdaq 100 ETF. It has delivered 18.5% annual returns over 10 years and the expense ratio is 0.20%. SCSD, that is Schwab US Dividend Equity ETF, has given 11.2 returns and also 3.89% dividend yield and the expense ratio is 0.06% in the last 10 years. RSP or Invesco S&P 500 equal weight ETF has given 10.7% returns and the expense ratio is 0.20% in the last 10 years. Weighted together, you get more than 14% annualized returns with a blended expense of 0.15%. That's more than 0.5% higher returns than the S&P 500 while paying only marginally more in fees. So let's go through this ETFs one by one. QQQ, that is Innovation Powerhouse. You will invest 40% of your investment in this. The focus is that the top 100 non-financial Nasdaq companies will be there in this. That is Apple, Microsoft, Amazon, Google, Nvidia. Performance 18.5% annual CAGR over the last decade. Why it works? Because technology and innovation drive modern markets. When AI, cloud or semiconductors boom, QQQ outpaces broad indexes. Next is SCSD, that is Dividend Stability Anchor. You will invest 35% in it. It focuses on the high quality US companies with a history of consistent dividends, more than 10 years. And the performance is 11.2% annual return plus a 3.89% average yield. So why it works? Because dividend paying companies tend to be mature with stable cash flows, smoothing portfolio volatility. Next is RSP, that is equal weight diversification. You will invest 25% in it. So the focus is that all S&P 500 companies are equally weighted, quarterly rebalanced. The performance is 10.7% annual returns historically. So why it works? It avoids the concentration in the mega caps. Also boosts the mid and small cap exposure in your portfolio. But the biggest challenge isn't about picking the ETFs. It's sticking with them when they are underperforming. QQQ will crush during tech sell-offs. In 2022, it dropped 33%, while the S&P 500 fell only 19%. You'll watch your tech-heavy allocation bleed, whereas S&P 500 just is fine. Like it will not go down as much as the QQ. SCSD and RSP will lag during mega cap rallies. But sticking to SIPs during the downturns means you buy more at the lower price. When the market recovers, your combined strategy outperforms. Imagine you have started with 1 lakh in 2015. So in 1 year, the portfolio would have become 1.14 lakhs. Okay, the S&P 500 would have been given 1.13 lakhs. So you get that 1,000 difference. Okay, in 20 years, that difference will become huge. You have seen how combining growth, income, and diversification into a single discipline portfolio can outpace the market and also make the volatility smoother. So here's your call to action. You can start small, even 5,000 per month SIP in 40%, 35%, and 25% in QQQ, SCSD, and RSP will work wonder over time. You can set up the recurring investment and stay hands off. And in, say, for example, 5 to 10 years, you see your wealth increases. Rebalance annually. Schedule a calendar reminder every January to rebalance. Because say for example, if QQ has given a very good returns, that 40% of your QQQ investment will become 50%. So you have to rebalance, moving that 50% to 40% again and reallocate to SCSD and RSP. Commit for 10 years. Patience is your greatest ally in investing. Thanks for watching. If you found this helpful, don't forget to like, share, and subscribe for more insights like this. Thank you.